from a risk adjusted standpoint, we really believe that there's no better asset class in commercial real estate today. And I say on a risk adjusted basis because we really, it's great to look at the upside and where we could take returns. But I think the most compelling case for the infill Class B industrial space is on the downside and downside protection there.
We were just chatting and we were talking a little bit about social media. You and I met on X, which is kind of fun because I've met actually real people on the internet, which some of them I like more than the real people that I've met in real life. And you said that you were on a podcast and then someone reached out and you did a deal from the podcast. How did that work? And maybe that'd be a good place to start. And you can kind of describe maybe some of the ways that you're doing your industrial investing slightly different than other people.
Sure. Yeah. Well, number one, thanks for having me. I know we've had a chance to connect and chat a few times, and it's been fun to talk about industrial real estate and excited to do more of that today. But yeah, had an opportunity, 9 months ago to be on an industrial podcast. I've been spending some more time trying to engage in X and LinkedIn. And to your point, I've been blown away by some of the people I've had the opportunity to meet, some really smart people, some interesting people to be able to talk through not only industrial real estate, but all different asset classes and just hear a lot of different ways people are doing things and make connections all across the country that never would otherwise have made. And that's turned into actual deals, just relationships made on X and LinkedIn. But yeah, the one specifically that you mentioned, we were on a podcast and a handful of folks reached out as a follow-up to introduce themselves. We can talk about it more, deal sourcing mainly through the brokerage network, and a broker reached out and we looked at 2 deals and the third that he sent stuck. And 6 months later, we had closed a deal with him in his market. And it's fun to have those success stories that we can look at and point to an absolute direct result of social media or a podcast like this.
Like all real estate, I feel like, but maybe industrial symbolizes this the most. There's the biggest institutional guys investing in industrial, like biggest of the biggest, Blackstone, right? And then you have the smallest guy out of his truck. How are you thinking about competing when there's such a wide range of different types of investors and you are investing throughout the country? So what are you doing?
It's a great question. And it's that specific question has driven some of our strategic focus and where we want to play in the space. We historically, our group, we're small investment shop. We formerly the partners of our company were in the brokerage business. I worked for a company called Stan Johnson Company that specialized in net lease investment sales across the country, plus or minus 15 offices, 100 brokers across the country, but didn't really matter where we sat given the nature of single tenant net lease deals where we had the most of our expertise. We were doing things across the country. So we felt like where we could have a competitive advantage is those relationships that we have with brokers all across the country, not only with the brokers across the country, but in a lot of, we've got great relationships with the big household name brokerage shops, but also given that Stan Johnson Company was somewhat of a niche boutique investment sales firm, we had some really good relationships with those local independent brokerage groups in different offices across the country and in different markets. So that's been really a critical relationship for us. And we felt like that was a unique aspect for us, that we could go to a lot of different markets and connect with a lot of different people. Networks like SIOR and certain different real estate associations in the industrial space have been critical as well to get to know those brokerage relationships. But to your point about the larger institutions, we specifically made it part of our investment thesis to play in the $3 to $15 million per deal size space because we wanted to be sub institutional and not, we don't want to compete with Blackstone every day and what we're doing. And those deals a lot of times are just too small for what they're doing. And then that gives us an opportunity. There may be an aggregation strategy where we're able to go out and buy a larger portfolio of $5 to $10 million assets and put them together and then have a critical mass that then is interesting because, as you know, a lot of those groups are getting into the infill Class B industrial space and they want exposure there. It's just really hard to get to a critical mass for them, doing $5 million deals one off.
So not a lot of people know this, but basically a year ago, we launched an industrial platform. We've gotten 2 Class B industrial deals done. I love industrial. It's the complete opposite of hotels. It's a lot of fun. I think part of the reason why I love it is because it's the complete opposite and it feels like something totally different and it doesn't take away from what we do on the hotel side. But where we start to focus is also on the sub-institutional side because I just was concerned that I'd be like the dumb money showing up. And I thought I could outcompete a guy in the back of the truck with our kind of infrastructure and our local network of brokers and relationships that we built up. But do you feel that sub-institutional is scalable for you, or is that just where you started because it made sense from a capital standpoint or because you were just starting out? Or is this something actually that you think is a bigger business that you could grow focusing on sub-institutional?
No, we definitely, we don't have plans of, using this as a stepping stone to focusing only on larger assets. We do believe in the scalability of the sub-institutional space. And part of that is, just how we're a pretty lean shop. And it's also driven by where we believe the opportunity is. And to your point, in the sub-institutional space, a lot of times it really is a pretty fragmented market in terms of ownership. And a lot of these owners have owned these properties for a really long time. And the asset class has been overlooked for a number of years. So to be able to come in and deal with, on the sales side, I always hesitate to say non-sophisticated because a lot of times they are very sophisticated in the business that they run, but not real estate has always been kind of an afterthought, whether it's a Class B industrial building or an industrial outdoor storage yard. A lot of times these people owned the real estate as part of their operations, and maybe they sold their business but retained the real estate. Maybe they are just winding everything down, whatever the case may be, not necessarily out playing in the real estate space every single day to know really how to maximize the value. There's plenty of meat on the bone. A lot of times they've owned these assets for decades plus. So they've got a great basis. They're making good money on it, but we feel like we can come in and really take it the next step, create some value. Typically we're trying to market the rental rates, buying with in-place lease rates that are below a current market value and create value that way.
What's the business case for Class B industrial? Like, why focus specifically on Class B? What's so special about it?
I think, this is, I'm biased maybe, but from a risk adjusted standpoint, we really believe that there's no better asset class in commercial real estate today. And I say on a risk adjusted basis because we really, it's great to look at the upside and where we could take returns. But I think the most compelling case for the infill Class B industrial space is on the downside and downside protection there. We try to underwrite to multiple different exit strategies, and we've all seen those. Maybe the classic net lease deal is the best example where if you had a retail tenant like Walgreens or something where, they've been in the news and closing stores, and you don't want to typically own a Walgreens asset if it goes dark. They're paying a rent that's very difficult to replace. It's a specialized asset. And it's great if they stay, but if they leave, it's not pretty typically. And so that's what we like about these properties. We're buying these, and I think there's opportunity to buy assets like this at a basis that is really attractive, where you can pursue multiple different angles and still come out really really well. And even sometimes the because most of what we do is single tenant, or maybe up to 3 or 4 or 5 tenants. We're typically not doing the 2,000 to 5,000 foot bays. I think that's a great strategy, and your risk obviously isn't so binary, but it just has us focus that much more heavily on a functional building where it has a replaceable rent. So we underwrite a scenario where we keep a tenant and they continue to renew, and eventually we can bring them closer to a market level rental rate. But if they don't renew, that focus on the functionality of the building, where it's located, the truck courts, the clear heights, the building features, all of those things that we spend a ton of time underwriting. We believe we get a vacant property a lot of times because of the lack of supply for these buildings. Actually, a vacant asset is worth more sometimes than a building sold with a below market in place lease rate that is valued on a cap rate basis. So, we may be able to buy a building for a quote unquote downside scenario. The tenant blows out. We could turn around and sell it vacant to an owner user at a much higher basis. We could go lease it market to market and lease it and then sell it on a cap rate at a much higher basis. So, there's always scenarios where you could get in trouble. But if we do our underwriting correctly, we think there's 3 or 4 ways out of the mousetrap, so to speak, where we could hit the returns. It doesn't have to be, this is the one scenario that we have to hit our underwriting. It could be 3 or 4 different scenarios, and we're still hitting the returns that we're targeting. So that's what's exciting for us. And there's not that big gotcha there. We try to dream up a bunch of different scenarios, and typically none of those scenarios you lose your shirt on.
That's why I like industrial, is a nice balance to hotels. It's the opposite end of the risk spectrum, and it's not 12 different operating businesses that we have to run. The other thing that's cool is from like a CapEx side. So when you buy these things,
No doubt.
what is the typical business plan? I got it. You're going to market the rents, but what do you have to do to the building most times?
Yeah, I mean, the big things you look at, the biggest CapEx, let's put structure aside and assume that, obviously we want to check the structure of the building and make sure that's in a good spot. And then environmental is a big piece that we want to check that box. And we're pretty risk averse on environmental. We're not willing to take, if there's recommended environmental concerns or anything like that on a phase one, typically that's a risk we're not willing to take typically. But outside of those 2 items, you're really down to the biggest things being roof and paving and parking lot. So, and those 2 items are really predictable. You can get a third party out there and tell you pretty reliably how the roof is and what the remaining useful life is, and same with the parking. So, and then you can look at, sprinklers are a big ticket item, but again, it's another thing you can get assessed pretty easily and pretty reliably. And then you include that in your underwriting, and from there, because of, again, back to the lack of supply, you've got, whether it's metal or a concrete box and a limited percentage of office, there's just not much that needs to be done. And we continue, we've done it multiple times. We've seen it done. Brokers in all these markets, have seen it done multiple times, but every time we do it, that being putting paint on a concrete building, it is incredible how much value that creates by just putting a little lipstick on a building. It looks so much different because the bones of that concrete box don't change much. And you put a new coat of paint on it, and it looks like a new building.
Yeah, I remember on our first deal, the CBRE guys, and I think I told you this, like we were talking with the junior brokers and there was just, young kids making their way up. And I was like, what do we need to do to the inside of the building? Like, what do tenants like? And they're like, oh, you put a fresh coat of white paint on this thing. And then on the corners, make sure you put those yellow stripes. Tenants love that. I'm like, okay, that's all we have to do. Like, we're ready to go. Let's do it. Talk to me about marking to market the rents, because oftentimes brokers say this across a variety of real estate types. And mostly, I think it's bullshit. Like people mark to market their rents often. But in Class B, I think it's actually true. Why are these rents oftentimes below market?
I think we sit in a really unique position here today, and you look at, it's best shown by in a graph where it shows rent growth over the past 10 or 15 years in this asset class. And there was in 21, 22, a dramatic spike in rent growth, especially, not in all of industrial, but especially in this infill Class B space. So we sit here today where an historically abnormal period of rent growth, any leases that were signed 3, 4, 5+ years ago, even if they were on a 5-year lease term, but they've had renewal options that were fixed and continue to renew, any of those leases now, because we've had such a dramatic amount of rent growth over the past now 3 to 5 years, those are significantly below market. So I think we sit in a unique time. I think 5 years from now, the percentage of properties that are below market won't be the same, because I don't think we'll experience 35 or 40% rent growth over a couple year period again. Maybe great if we do, but I don't think that'll happen again. So I think that's the biggest opportunity right now, is what we see is that historically abnormal strong rent growth has led to a larger percentage of these properties being below market, because anything inked, you know, 3, 5+ years ago now is, we're not just talking 5 or 10% below market. We see assets regularly that are 30 to 60+% below market, because that's just a lot of times that's how much the market rents have grown. And then back to what we were talking about earlier, a big percentage of the ownership group of these asset types are not, your day-to-day real estate folks. And this may have been an asset that they didn't hire a broker for, and they just leased it up on their own and didn't really push to get to a market level rent when it was originally signed.
So when you're buying a deal, and let's just say, the daughter owns it, her dad built the thing, she inherited it, probably a common story. These tenants have been there for 10, 15 years, and the rent is well below market. How do you approach all those renewals? Are you kind of expecting that you're going to go, hello, nice Mr. Electrician, we're raising your rent 20, 30, 40%, that those guys are going to leave? Or do a lot of them end up staying? How does that work? And how do you actually go about doing it without, getting whacked with like a pipe or something?
It's a great point, it's easy sometimes to talk about the business and the modeling side of it, and it gets lost, the actual tenants, and it, I- we really do try to view the tenants that in the buildings that we own as partners, and we've got a business plan that we need to execute on, and the price we're paying for buildings is contingent upon being able to execute that business plan, and they get it. But what we never want to do is, we never want it to be a surprise. Number one, they come up and there's a 60-day renewal or 90-day renewal, and then all of a sudden, wham, they're hit with some really unexpected significant rent increase. That never feels good. And then the other thing is, we underwrite these properties where we're trying to offer at least some level, whether it's 5 to 10% below market, to keep tenants. It's still there's a lot of incremental costs that go along with losing a tenant, from downtime to leasing commissions and TIs, et cetera. So we always try to underwrite not only to allow the tenant to feel like they're getting some discount to market and not have to move, but also I think it's mutually beneficial. So we'll typically try to come in and have a frank conversation to say, here's who we are and here's what we do, but we still want to work with you. Your rents today, and a lot of times these tenants know. I mean, they know if they're 50% below market. So a lot of times it kind of goes for itself when it speaks for itself when we come in and a national group buying a building, they get it. But to be able to talk to them and say, here's what we plan to do, and give them some runway as well to go out into the market and see for themselves. Because when they are not out in the market every day and they see here 30-40% rent increase, they think, oh, that's crazy. But then they go out into the market and see, gosh, there's just nothing available. And maybe we are getting a decent deal, like this isn't the tip top of the market. So that helps significantly. And sometimes we do lose tenants, but especially recently, more often than not, we've even had scenarios where we've acquired buildings, larger buildings it was a 140,000 foot building that we acquired. The tenant signed a 1-year sale lease back because they wanted to consolidate or not consolidate, downsize their operations in the market. They wanted to move from 140 down to 80-ish, sold us the building on a 1-year lease back. They went out to the market and looked for 6 months. And then they came back to us and said, we can't find 80,000 feet. Can we lease it? Even though we sold you the building, can we lease back 80,000 feet of this building? So more often than not, we're able to keep tenants. And I think a lot of that is because of the supply story in these markets. But we also, again, I think some of it is trying to be a good landlord, really trying to develop a partnership with the tenants and not worry about the last nickel on rent, more so trying to maintain a relationship and keep a tenant in place.
Is part of the strategy also converting these from gross deals to triple net deals? And maybe you can talk about what triple net actually means, because everyone's got a slightly different definition. So what does it mean in your deals? And is that part of the strategy?
It's a great point. And it absolutely is a strategy that we focus on. And I think it's a major value add in this space specifically, back to maybe the historically less sophisticated ownership group that has been fine with gross leases or modified gross leases, where as more sophisticated investors get into the space, more and more prefer net leases. And then we're seeing a trend of, more passive 1031 exchange driven net lease investors getting into industrial real estate as well. So not just, your stereotypical Starbucks or CVS type buyer willing to go into the industrial space for all these reasons that we're talking about. And the more, and obviously the quote unquote passive 1031 exchange guy is oftentimes willing to pay a little bit more than your, local legacy real estate investor in a specific market. So I think there's some way on a very similar NOI, all things being equal, if you've got a net lease and a more passive ownership structure on the sales side, I think you can drive better pricing. So for us, we try to get to an absolute net lease if possible, where, especially if it's a single tenant deal, where, not only operating expenses, but insurance, real estate taxes, and then everything, roof structure, parking, the tenant's responsible for all of that. I would say more often than not, we as the landlord are still remaining responsibility for replacement of roof and structure. It depends a bit on parking, and we try to, especially if there's some outdoor storage component and there's a heavier use on the yard or the parking, we try to have that as a tenant expense. But that's how we think about net leases.
Where do things go wrong on these deals?
I think it's back to the functionality of the building, getting into a property that is more specialized than maybe it looks on the outset, or overlooking one of these big capex things. There's not the list isn't huge of the capex things, but if you buy a building that doesn't have a sprinkler, and then you try to, maybe the use was grandfathered in, your tenant leaves and you find somebody else, and you realize you've got to put a $500,000, 750 million or $1,000 sprinkler in. I would say most people aren't including that in their underwriting, or they should have on the front end. So I think that's from a functionality standpoint, whether it's missing something like that the building needs, or potentially just sitting there vacant longer than you expect. The period that we continue to sit in is historically low vacancy period. I don't think that's going to last forever. And some people have been rewarded for, when tenants can't find space right now, they're willing to make things work that maybe aren't exactly ideal from a functionality standpoint for them. But, if there's a macroeconomic hiccup, or, things go south from an economic standpoint a little bit and everyone is impacted, maybe there's some additional vacancy, and tenants then have the opportunity to be a little bit more selective on space that fits their needs. And then all of a sudden we could see some of these properties that are a little bit less functional sit on the market for a bit longer, not drive the same rental rates. So I think it all goes back to functionality. And you could overspend. I would say you could overspend on a TI package. Again, putting a TI package in that is above standard for a kind of a special use, and then that tenant blows out. And then we've seen this many times where that tenant leaves and the owner said, well, my future tenant will be able to use that. Like, no, that was a very specialized, R&D use. You have to rip all that out to get it back to a base warehouse.
So when you're going through a deal, when you're going through an underwriting, what are like the initial things that are a no-go for you, where you're like, we're not doing this deal? Like characteristics of the building, characteristics of the tenant, location. What are those types of things where you're just like, guys, we're not looking at this thing?
For us, we say we will buy in top 150 markets. So it's a pretty broad criteria there. It's really just market size is 400,000 and above in terms of population. We'll go tertiary, but we don't want to be extremely tertiary. And then from a building standpoint, within that market, we want to see, even if it's more secondary or tertiary markets, we want to see that the submarket and the location of the building is somewhat infill in nature. That we continue to see, even in smaller markets, location matters, and the proximity to population bases, to labor bases, significantly matter, and matter more sometimes than the building characteristics themselves. So I would say that's a big one. And then just, back to functionality. We really, it doesn't have to be brand new 34-foot clear, but we start getting hesitant anything below 20-foot clear. We've done some 18 feet, but typically if we're below 18 feet on a clear height, it has to be a pretty compelling case. But typically it's a pretty quick no there.
Is there anything special about 18 feet?
Yeah, it's just, a lot of these tenants, you get into a position where it's really hard to have any sort of racking. And then you get into, you really have to be kind of manufacturing or light manufacturing. And even, you walk a manufacturing property, they typically have some type of warehousing use within that, where there's some rack spacing. So I would say that's a limiting factor oftentimes. And then, ideally you'd have one dock per 10,000 feet, but you don't really, as long as you have a handful of docks that could be used for distribution, You have a handful of drive-in doors or ramps that can be used for forklifts or kind of fleet vans if that's what's needed. Again, back to being able to look at sprinklers. We probably wouldn't buy a building with that's not sprinkled. So those are, the quick check marks. And then just kind of rectangular boxes. Some of these buildings you look at that tenants have been there forever and they continue to expand, and there's an L shape here and a scabbed on building there. And, you think about trying to put someone else into that space, it could get a little difficult.
Let's go back to starting the business. So you're working for a bigger firm. You were on the brokerage side. What was it that made you want to go out and become an entrepreneur?
Yeah, I was really fortunate to work in a Stan Johnson company, to have the boutique investment sales firm to work in that really had an entrepreneurial culture. And the team I was working on, we're typical investment sales on the disposition side, but we had also done a number of joint venture equity partnerships for build to suit development projects. And we were bringing some good preferred developers for national credit industrial tenants, bringing them to the table, creating a joint venture partnership, and doing a number of different build to suits across the country, which was a great partnership. But we then saw the value that we were bringing to really good developer clients, not just on the disposition side, but on the front end, helping them to capitalize their pipeline of new development projects. So we started focusing there more and more. At one point, kind of looked around and the senior broker on my team is a guy named Jeff Hughes. He was, I think, employee number 3 or 4 at Stan Johnson Company. So Stan and Jeff had invested together for a really long time and extremely smart, and said, we've got some liquidity here internally, and we don't necessarily have to go out externally to bring capital to some of these developer clients. So we started being that LP capital, investing on build to suit projects, and that snowballed a little bit into where we had the opportunity to become kind of an informal investment arm of the brokerage business, which then led to brokers in different markets. We had a Chicago office, an Atlanta office, a Houston office, seeing an opportunity and saying, gosh, I think if I had $7 million, I would buy this deal. Let's buy this one together. So that continued to snowball, and really it came to a head when the legacy brokerage business sold to a larger brokerage shop out of Minnesota. And that was really an opportunity to take, and we had officially formed TruCore Investments, who we are today, a little bit before that. But that was really the opportunity to step out, sell the legacy brokerage business that Stan had built over 35 years. There was a liquidity event for some of those partners that are our partners here today. And then a guy I was working with on the brokerage side, Zach Harris, he came over to TruCore. I came over to TruCore, and really that's kind of running the day-to-day of what we're doing now. So it was an opportunity. It was something that we got a taste of when we were doing brokerage, and felt like, it was an area that we really liked, but also felt that we had an opportunity from a competitive advantage standpoint to create value on the kind of principal and acquisition side.
What surprised you most when you started your own firm?
Yeah, I mean, I would say the transition from brokerage to more of a principal role. It's easy to sit in a brokerage seat, and there's a lot more that goes into the transaction management, the closing process, the underwriting process. It's kind of easy to wipe your hands of it and help through the closing process a little bit, but it's a lot more work to get through the transaction, a lot more pressure, so to speak, in terms of as in a brokerage role, you do your best to underwrite the market and underwrite rents and et cetera. But when in the more principal role, that you feel like you have to go 3x or 4x deeper just because this is, the investment underwriting is hinging on this, and people are putting their trust in you in the form of capital to invest alongside you. So I would just say, that's been a big change, but it's one that I enjoy. I think we enjoy a lot in terms of going that layer deeper and really hyper focusing on building functionality and what a specific vacancy looks like in a market, and what the velocity in that market, how many square feet are tenants looking for in the market today that they haven't been able to find, and things like that, where you go that initial that extra step beyond what oftentimes we would need to do in brokerage just to get that much level of comfort on an acquisition.
One of the cool things I like about Class B industrial is there's not a lot of change from one building to the next. There's a lot of consistency. How have you fine-tuned your acquisition process from like starting from the beginning, sourcing a deal, all the way to closing the deal, to eliminate noise, to eliminate waste, and to do it like very entrepreneurially? Because it's just like they're all very similar. So you can almost have like a plan, a program to go through. So like, what have you done start to finish to perfect the process?
It's a great question, and it's one we've thought a lot about, because you're right. I mean, and for what we think a lot about the funnel, the number of deals coming in, tracking how many deals we need to not just get sent, but actually number of deals that we need to at some level underwrite, and then how many of those get to an LOI submission, to an accepted LOI, all the way down to a closed property. So we've got to look at a lot. And what we've done is develop what we call kind of the 100 questions. I think it's more actually like 113 questions for us, but 100 questions due diligence checklist that we've got. And we've ourselves, our analysts will go through and we get the building specs. And a lot of that is just back to clear heights and number of docks and size of the truck court and different metrics like those. Those are included in our 100 questions checklist. And then we have a stated criteria. We want it to fall within this range, and, highlight it green if it does, highlight it yellow or red if there's significant concern or just something to focus on. So as we get a deal in the door, and you more and more can look at just kind of, does it pass the eye test and pass the sniff test? But once it does, and we go through that 100 question checklist, formalizing and standardizing those questions for us has been a significant value add, from the speed and efficiency to underwriting, but also I think preventing us from letting something slip through the cracks and looking up and say, wait a second, does this, is this building sprinkled or not? And it's a checklist item that we have to go through in our underwriting process.
I love that. That's cool. What about on the ownership side? A lot of these buildings or asset management processes are mostly non-existent until you show up and you own it. What are you doing differently as an owner that the tenant might see and recognize?
We've a lot of these owners are, and a lot of times people ask the question, well, why didn't the former landlord bump these tenants to market? And it's really interesting. We see pretty often, because of the fragmented ownership base, historically a lot of local and regional owners that are self-managing the property, they've developed personal relationships with these tenants. Rents have grown significantly. And it sounds silly to say, but we've seen it over and over. They just don't want to go to their friend who they've worked with for 10 years and say, sorry, I'm bumping your rent by 40%. And so their way out of that is to not be the bad guy and sell the property. And they know, because they're able, in the market we sit in today, they're able to get some cap rate compression on the exit because the leases are below market. So that's how they're getting some value based on the below market lease rates, and not having to be the bad guy to go to those tenants. But so a lot of times they don't want to approach them. They don't want to dramatically increase their rents, but it's also a local owner that hasn't really, they haven't had to do much to the building because of the point that like you said earlier, they don't need anything special. If you, if the carpet's a little dirty and maybe some of the paint's chipping in the warehouse and missing a few ceiling tiles, they really don't care. So I think it's an opportunity where these folks have owned these buildings for so long, it's not broke, they don't have to fix it. And we come in and they haven't seen what happens if they do paint the building, and if they do spend some money, they don't quite realize, I'm getting X rent today, but I could spend this to get Y. It's just been they've got a good basis and it's spitting out some good cash flow, and we don't really need to invest dollars in it. So we're able to come in, and maybe it helps to be, we're always competing a bit, being national and not being boots on the ground. There are folks that, know a specific submarket better than we will ever know it. And they have an advantage there. But I think where we have an advantage is to see nationally what national buyers will do, what they look for, and how it can work if you spend some CapEx and improve a building, how that can drive rents.
We had a guy on the podcast that said he missed so many deals in his hometown because of the bias that he was bringing to those deals. Like, he was anchoring his price based on, what he saw maybe when he first started 15 years ago or something. He's like, how are these guys paying this much money? They're from New York. They don't know what they're doing. They don't know what they're talking about. And then the New Yorkers sold it and made a ton of money. And he's like, I missed it. So, being local is an advantage or a disadvantage. How have you dealt with that and made sure you're not the dumb money from out of town?
It's hard, but that exact scenario we've seen play out in a lot of different markets, because we're able to come in and they're anchoring off of prices, and a lot of that is back to the change has not been gradual in the valuation of these assets. For 15 years, these buildings have traded within a pretty tight range on a price per square foot basis, because it's been mostly local ownership, maybe some owner users. And so everybody kind of had it in the back of their mind, these are worth X to X, and that's where they trade. And then that has dramatically changed. A lot of those local folks that have invested forever, like you said, are anchoring on, are struggling to believe it, are struggling to, we see it even with some brokers in markets that they've been, they're the most decorated broker in the market. They've done the most leasing, but it's almost like they've know too much, because for the last 20 years, this is a $5 a foot building, and now it's an $8 a foot building, and it changed so quickly, or $9 a foot building. It's hard for them to catch up to where the market and truly believe where the market is today. So we've actually had some pretty significant wins that playing that exact role that you're mentioning, where we come in and we're willing to pay, if forever it was a market that was these types of buildings were trading at $70 a foot, we come in and we're willing to pay $80 a foot. But we believe, based on comps from owner users, based on the national market, based on some other things, we believe it's worth vacant and available today at $90 or $95 a foot, and replacement cost is $140, $150 a foot. So we we're willing to pay a little bit more than those local guys, but we're buying it with a lease in place. So we feel like we're getting a discount to that owner user. And then the business plan on those has proven out to where we go to market, whether it's for lease or for sale. And, the market has continued to trend in the right direction for us and provide additional tailwinds where, maybe some of the local guys think, gosh, they stretched a little bit for that. And then a couple of years later, we sell it for significantly more, and they're kicking themselves because they knew, but they just couldn't. It was hard to truly believe that that's where pricing is today.
Yeah, I mean, they're local. So if they make a mistake, they're going to have to be the one that's made fun of all the time. And you lost money. If you're out of town, you're never going to see those people again. I want to go into if there's any tenants that you will like refuse to have, or if you're looking at a deal and you're like, oh, we got to get this tenant out of here. I don't want this.
Yeah, as more and more different states have approved medical marijuana and things like that, that's not a use that we've been interested in getting into. And really, we are less credit focused right now because of just back to the real estate fundamentals. If we feel like we're getting a property at a good basis, that at a really replaceable rent, we're less concerned about the credit, because there could be a situation where they leave. I mean, we're able to, it's a positive that we're able to bring in a tenant that's willing to pay more. So I would say, dirty uses from an environmental standpoint, we will hesitate on. Maybe some uses that are really hard on buildings that can tear up your yard or things like that. But and then I would say we've been less excited about these infill properties. One of the pros is the adaptability and flexibility of these buildings. And when they were built maybe 30 years ago, it was on the outskirts of town. But now, as urban sprawl and they're somewhat infill near rooftops, these buildings that were built 30 years ago, and you see whether it's pickleball courts or gymnastics, or we've seen wedding venues and dog parks and all sorts of kind of pseudo retail uses.
Yeah. Yeah.
We love it because it's eating up and absorbing the space and limiting supply. But we're typically, we prefer a true industrial use. Now, if a trampoline park was willing to pay 2x rent and a low TI, would we look at it? I'm sure we would.
Let's go.
That's
And it's
right.
fun. You'll get a discount on the trampoline park. I like it. Take
That's
your
right.
kids there.
That's right.
Talk to me about your hold period, because one of the other unique things about industrial versus multifamily or obviously hotels is you're signing multi-year leases. So once you execute the business plan, there's a lot of consistency and a lot of the upside is already built in and baked. So you're starting a company, track record's important, cash flow is also nice, but how do you think about transactions, selling and hold in that context?
We underwrite everything to a 1 to 5 year hold period. We're not buy and hold forever investors, and we're typically, as exactly what you said, once we create value, we're looking for a capital event. That could be a refinance and putting some longer term debt on and cash flowing it from there. But historically, we've leaned more towards creating value and then looking to exit. And that's been exiting typically on a one-off basis on a property. We, in the future, as we continue to build the portfolio, maybe back to we talked about a aggregation strategy. Maybe that's something like a portfolio exit. And right now historically we've capitalized a lot of these deals with relationship lenders, but equity has been a lot of internal capital and some friends and family on a deal by deal basis, where we're now moving to the fund route. And within the fund, it makes a lot more sense within the fund, and we're acquiring within the fund right now, makes more sense to consider something on a portfolio strategy. But equally, if there's a value creation opportunity, we kind of owe it to ourselves to look at the exit and can you realize the value that's been created.
Why was setting up a fund important to you, and what does the structure look like?
For us, it was important to us from from an efficiency standpoint. We've been fortunate to have some really good capital partners that have continued to invest with us for years and years. But the nature of the deal size for us, our average deal size is about $6 million. We'll buy some larger, some a little bit smaller. But you think about the check size, the equity check size on those is relatively small. And so we've had some really good folks that have invested with us or also that have wanted to invest with us. But, they say, gosh, writing anything less than a $2 million check, yeah, it's just not worth the time for us. And we've got legacy investors, we've got internal capital. It's hard to totally say, hey, I know, thanks for investing with us for, 7 years, but we're going to go to this new guy on our next deal. But then there's just not enough space to bring other new folks in. So it was really an opportunity to broaden our investor base and allow folks that want a bigger allocation to then allocate it across multiple properties, but then also just a diversification play for our investors, not necessarily picking and choosing single assets, but being able to spread their investment across, for this fund, we plan to buy 12 to 15 properties, investing that capital across 12 or 15 properties where that risk return profile isn't so binary as maybe we bought 12 deals and they only wanted to do 3 of them, whatever that looks like. We like the diversification of if one doesn't perform as well, that you've got 13 or 14 others that can help accommodate from that one that didn't do as well.
What's the size of the fund?
So we're hard capped at 30 million. We're expecting somewhere between 20 and 25 million. The goal for us was to go smaller from the start. That gives us, 65-ish million, 70 million in buying power for the fund. And what we really wanted to do is go smaller for a couple reasons. We wanted to feel really confident in being able to deploy it within our stated investment horizon. So our objective is we said 24 months. I think we can deploy it more quickly than that because we've all invested in funds that they raise a certain amount of money. And listen, I appreciate the other side of the fund is their compulsion to put money out and you start doing deals that maybe are not great deals. So I appreciate not buying bad deals, but it also doesn't feel great if you've allocated or given a commitment for X amount and only 50% of your commitment is ever called over the fund life because, you earmark that capital, there's an opportunity cost there. So we didn't want to raise so much that we felt like we were compelled to start doing deals just to do deals, but also raise an amount that we felt really confident in being able to deploy over a short amount of time. And then, the risk of going too small, we didn't feel like that was a real concern because we execute on the strategy. We find deals that we really like, and then we can move on to the next fund.
I think now is probably some of the most challenging times I've seen since 2011 in terms of raising capital and getting investors to commit, despite what I think is a tremendous opportunity in a lot of real estate classes, given all the dislocation in capital markets and illiquidity across other investors. What's your approach to raising capital and how are you sourcing your investors?
I agree. I think it has been challenging, and I'm curious your thoughts if you're out there, raising and what you've seen in the market. For us, it's been really relational based and, focusing on not just legacy investors, but, introductions, one or two degrees removed from a network standpoint. That's been really important. And then, face to face is always it's always been important, but even more so now. I think there's just that much more scrutiny placed on where capital is going, and it is a tougher environment right now. So I think for us, it's been really relational driven, trying to get in front of and be able to sit down with as many folks as possible to tell the story, talk about our track record in the space and some of the round trip deals we've been able to do. But curious what you've seen.
We've been having a lot of trouble breaking into a lot of family offices that I would say are in the $3 million to $10 million investment range. We have a lot of high net worth investors, and then we have our institutional capital partners. And institutional capital partners, I think, are generally very cyclical, actually. And the issue with some of the high net worth investors is illiquidity. And I think family offices have illiquidity too, because they're stuck in deals that they did from 2021 till now. So part of our strategy to target more family offices is because potentially they're less prone to illiquidity issues. And I think there's a lot of value to spending less time raising capital and more time diligencing deals and also sourcing opportunities. So the more people that we can go to contribute larger amounts of capital to our deals, it's just efficient. But we've definitely struggled in some ways to break in to that level while we have a lot of capital sources in the million-ish dollar range.
It seemed like uh, I agree with everything you said, and it just seems like decision making is slower too. It's not necessarily feel like we're getting much more longer drawn out answers than we've typically seen, just because there's so much volatility going on today. Folks just considering maybe we just stay on the sidelines but not really being real convicted on it either.
100%. And you get people that don't have enough conviction or don't have enough, I don't know, maybe it's capital to just say yes, but then at the same token, they're not really saying no either. So there's a little bit of this limbo. And I'm like, you got to get off the ledge. Like, we are closing this deal. What are you doing? And it's definitely been interesting. I think the stock market volatility played a major impact. And I think now that the stock market's up, we've seen definitely more comfort, but it also depends on where people are just in their liquidity profile. Like, if you have a family or an individual that is printing massive amounts of cash flow in their business, then I think they're a great investor and they want to deploy. But if you are targeting, older rich guys and gals that are investing their life's earnings, they're definitely a little more cautious. So part of our strategy has been to try and identify, families with real cash flowing businesses, because they've got more money coming in and they can put money out, and that's what they want to do.
Yeah, yeah, makes a ton of sense.
And our investors are all over the country. Have you kind of met people online, through Twitter, through social, that have actually invested in your deals? Or are they really all directly known by you or your investors?
Yeah, good question. We have just we've had folks reach out for sure, and we've had conversations with them, kind of actively having conversations, but we've been somewhat hesitant. And back to the decision that was driving the fund conversation was partially because of that. We got connected with some folks that were interested in writing some bigger checks, and we just didn't have. It's a good position to be in, but we just didn't have room to accommodate both that and legacy investors. And so we kind of said, let's wait. And so I think the fund will be an opportunity to pursue that angle some more, because we would love to we would love to expand the network of investors that we have. I think being it always is interesting to me, how as you expand your network, especially because we have a national focus from an acquisition standpoint, I think it's just net accretive to us to have a national investor base as well, because a lot of times if somebody's investing in industrial real estate, this isn't their only real estate vertical, and they've got relationships here and there, and then all of a sudden, you get introduced to another deal that you can pursue. So it's something we've been interested in doing more of. I'm curious if you're willing to share, what's that looked like for you guys? Has it been, you know, introductions? Has it been the podcast? Has it been what's that looked like in terms of growing that more national network?
I like having a funnel, and we try and track where investors have come from through, we use Juniper Square to do that. And most of our investors tend to come through word of mouth, through another investor or a friend that knows me. But a lot of investors are actually just coming through social media, LinkedIn, the podcast, certainly. And, to your point, though, those investors are new to us. So we want to at least do one or two deals before we get comfortable. So for some of those investors, we may actually size their investment down a little bit, just so we're not as reliant on someone that maybe we haven't, shook their hand or had lunch with or something like that. And certainly if they're talking about a larger commitment, we'll go out and we'll fly there, and we'll really get to know them and understand what their goals are and what's important to them. But yeah, we're definitely a little bit cautious, but we want to make sure that someone who doesn't feel a lot of commitment to us or a relationship with us, isn't going to commit to 20% of our deal and then call us when we're calling capital and be like, something else happened, or I found this other deal. I do think, though, that getting capital direct from the source is the future. I think for guys like us, it's very difficult to raise these mega funds that were raised by Barry Sternlicht back in the 90s. And I think a lot of that is going to be a challenge. I think most of the people that do that are going to be people that worked at a fund like that and naturally have those big pension style investors. I think for more entrepreneurial people to break into big institutional shops from a pension or an endowment or something like that is very challenging. I think the biggest opportunity for guys like us, regardless of your track record and your AUM, is definitely on high net worth and retail investors, which, by the way, retail investors could be, have a bigger balance sheet than some of these big institutions. So it's a vague answer, but I think that there's a big opportunity in that. And people want to stop paying double promotes and double fees and just go direct to the guy doing the deal. I've invested in a couple big major funds, like major funds. And I get the reporting. I'm like, this reporting is garbage. Do you guys even know what it's mostly not on real estate? It's mostly in venture. I'm like, do you even know what these companies are doing? Cause you're not even telling me, you're just giving me the list of companies you're investing in, but what are you doing? And I think of all the work my team puts into asset management and writing these investor reports. And I'm like, you're running a $10 billion fund and you guys aren't putting in any, effort, it seems like, into the reports. What are you doing from a reporting standpoint and from a relationship standpoint and keeping up with your investors? Because I think that's something where a lot of firms drop the ball, after the person invests, just staying in touch and staying relevant.
I couldn't agree more. I think you said it. I think you nailed it. And we've had the exact same experience, whether it's been in non-real estate or real estate investments. Some of the biggest operators or funds that I've personally invested in, or some of my colleagues have invested in, have some of the worst reporting. And it's easy to say, I mean, in my mind, you think about, oh gosh, no, does it matter? Does the reporting matter? As long as the returns are good, all that matters is the returns. But to your point on word of mouth, I think that, returns matter, no doubt, of course, but the level of reporting, I think, has a significant impact on word of mouth and referral to new investors to you. And it's not a super high bar, but honestly and accurately communicating what's been going on. It's so easy for a lot of these folks that they're busy. Everybody's busy. They've got their lives going on. They uh, are running a business, running a family office, and may have 20 other real estate investments that are ongoing. They forget. They forget certain aspects of a deal. They forget what the projected returns would be and what the hold period was projected to be and all these different things. So I think you nailed it. I think that is really a big opportunity to differentiate yourself from other investors and drive that word of mouth by trying to be best in class in reporting and not just communicating the good news, but communicating honestly and timely if things aren't so good. But I think you nailed it.
Well, you've just inspired me. So we used to do quarterly video like webinars with our investors. And we have a lot of deals. So it didn't really work because people would be on listening to all these deals and some of them are in and some of them are not in. And then if like an investor's pissed off and they start asking questions, they're like, oh man, like thank God I'm not in that. It's just not the way to do it. So we do beautiful written reports, but I still like the video side. And I think what I'm going to come back to doing is like 5 minutes per deal every 6 months, like video, just straight talk from me from the gut with like a few notes, a few highlights. Maybe I'll bring on our head of asset management or our CIO or something, and we'll have a conversation about the deal. Because oftentimes we'll send out this beautiful report, and an investor will be like, hey, can we talk about the deal? I'm like, well, did you read the report? Because I told you everything I know about the deal in the report. They're like, no, I didn't see that. I'm like, well, okay, so we'll talk. But if you can do it in video and everyone can see it, I think people like hearing from the person because a lot of other sponsors, frankly, just don't do it. And it's a way to differentiate yourself.
Yeah, I'm trying to think if I've heard of someone doing that. I love the idea though, and maybe I'm wrong, but think the engagement, and because a lot of those reports, I think they're great and they're critical, but there's a pretty high percentage, I would guess, of people that never read them or they read
100%.
every fourth one or whatever.
100%.
I I think that those videos, especially if they're short, concise, they could just turn it on, whether they watch it or just listen to it on their phone. I feel like those would get listened to more than a 20-page report or even a 5-page report would get read.
Yeah, the reality is I can have this beautiful report that someone writes on our team and we all edit and everything. And we spend a lot of time on that probably aren't read all the time. Drop it into AI, be like, give me some talking points. Obviously, I know the talking points just because I'm involved in the deals and do them. And oftentimes I've found that investors just like to hear it from you. And if they see you, like we've had instances where people are like pissed, like, we survived COVID and we didn't lose a hotel. So we had to like, manage expectations and do all this stuff. So we had people that would email us like pissed and what are you guys doing? Da-da-da. And then we get on the phone. They're like the nicest person, you guys are doing a great job. Like I see it, I get it. I'm like, yeah, well, you could have just called and I would have picked up the phone and explained all this stuff to you. And now you would get it. So you inspired me to do it. I'm going to do it.
I love that
Um,
idea.
it's fun. Well, I'll send them to you and
Yeah.
you could send me yours and we'll trade ideas. We're winding down, but I want to ask you the closing question that I ask all the guests on the podcast, and that is, what is your favorite hotel?
Oh gosh, that's a good question. I have enjoyed, so there's a this is top of mind to me. I haven't done a bunch of, we live in Tulsa, Oklahoma. There is and then over in Bentonville, Arkansas, there's a 21C museum hotel. That's cool. There was one, I think it actually just got rebranded, but there was one in Oklahoma City as well. Fun to go stay there and then go to a Oklahoma City Thunder game. So top of mind, I don't have some exotic European hotel to give you, but top of mind, close to home. Those two are pretty cool.
21C, I love it, man. Those sold to a big brand. Like they were started, I think one of the Walmart heirs backed 21C and funded a lot of the art collection. And then they sold to a big company, Accor, I think. And, I always love when a hotel brand sells and makes a whole bunch of money and stuff. It's cool. So that was a good one. I love it. Thanks for coming on the pod. And where can people find out about you if they want to learn more?
Yeah, no, I appreciate it. Thank you for having me on. Really enjoyed the discussion today. And I know when we've had the chance to talk on the phone before, I feel like I've learned from you and fun to get to talk shop. So love to stay in touch. My email address, if we love looking at deals. So if you've got a Class B industrial deal, I would love to dig into it. My email address is hRose@TruCoreInvestments.com. True is just TRUE, or no E on True. So TRU Core Investments plural.com. And then I'm trying to be more active on LinkedIn. So connect on LinkedIn, and then on Twitter as well. Handle on Twitter is NNN_industrial. So would love to connect on social media or shoot me an email.
Amazing. Have a great day. Thanks for coming on.
Thanks, Jake.
Hey everyone, it's Jake here. Thanks again for joining me on this conversation. Be sure to subscribe on Apple Podcasts, Spotify, or YouTube. Lastly, don't forget to follow me on Twitter @Jake Wurzak. I'll see you in the next episode.
Jake Wurzak is the founder and CEO of Dove Hill Capital Management. All opinions expressed by Jake and his guests are solely their own and do not reflect the opinions of Dove Hill Capital Management. This podcast is for informational purposes only and does not reflect or represent real estate, financial, or investment advice.